Well, thank you very much, and thank you for coming tonight. I'd like to begin by acknowledging the people who are largely responsible for bringing Dennis here tonight. I guess I can't stop calling him Dennis. I've known him for 35 years, so what am I going to do? Anyway, the people that are really responsible for bringing Dennis here tonight is LAP, and they have sponsored his visit here. One other statement I'd like to make, and I think it's sort of a standard comment that you make before an event like this, which is a little on the edgy side, perhaps a little provocative. I would have to say that we understand that the views expressed here tonight do not necessarily represent the views of the sponsors. All right. So FERC has disclosed that economics is the major factor in the review of proposals, such as the Atlantic Sunrise Project. Since April of 2014, we have had issues about saving our woodlands, farmland, and our historic archaeological sites. Tonight, Dr. Witmer will analyze the economic viability of exporting natural gas and, if permitted, granting Williams Company the power of eminent domain. Dennis does not speak for the gas industry. He provides independent evaluations of energy technologies. He is a senior analyst with the Energy Efficiency Evaluations in Spokane, Washington. His clients include the University of Alaska in Fairbanks, KBR, BP, and several Alaska electric utility companies. Dennis flew here on his own nickel, is what I like to say, and he will be receiving no honorarium. Prior to 2009, he was the director of the Arctic Energy Technology Development Laboratory and a research assistant professor at the University of Alaska Fairbanks, and that was for a period of 10 years, 1998 to 2009. As an analyst, he has evaluated a variety of energy technologies, including coal-to-liquids and gas-to-liquids plants, waste-to-energy systems, natural gas pipelines for Alaska, and propane for use in remote power generation systems. He is an active writer in his field. He is the author of more than 46 published articles on the development of energy technologies, and very important for our discussion, since 2009, much of his research has focused on the task of providing energy to remote communities. He has a PhD from the University of Pennsylvania in Philadelphia, the School of Engineering and Material Science Department, is a bachelor's degree in science in physics from Millersville University. He was raised in Mardick Township, which I think you may already know, and he thinks of his talk as From Mount Nebo to JKT. So let's give a welcome to Dennis Witmer.
Hi, thank you. It's good to be home. I grew up in Mount Nebo, but on a small farm, which my dad told me when I was a kid wasn't economically viable. I had to find something else to do. So I got a degree in physics. I went to work for big corporations. I ran away for a while. But here I am back to talk to you about the landscape that I grew up in. What this talk is going to cover is I'm going to talk a little bit about just what natural gas is, and I'm going to talk about my personal use of natural gas. I'm a natural gas customer. We'll talk about that a little bit. Then I'm going to try and give you a perspective of the way the natural gas industry looks at its own business and the way that they make decisions about what they're planning on doing. So for a while, I'm going to wear the hat of somebody who's looking at this from inside the gas industry. The talk is limited to an economic argument. I am not going to engage in an environmental discussion. This is strictly about economics. At the end, though, I did include one slide where I will talk a little bit about my view of what needs to be done to address some environmental issues. And you're probably going to like that about as much as you like the pipeline. So what is natural gas? It's a hydrocarbon, which means that it's not a pure chemical element used as fuel. I'm looking at my high school chemistry partner, and that was the first day of high school chemistry, is what a mixture is, rather than a pure substance. So it contains more than one thing. It's mostly methane, but it contains other hydrocarbons. And people sometimes talk about methane from cows. I don't think it's a big source, but, it's fun to talk about. It can be trapped in geological structures and often co-located with oil reservoirs. So when people are looking for oil, they often find natural gas. It's useful as a fuel for heating or power generation, but it needs to be transported to markets, and we're going to talk a lot about the transportation part of that. Usually it's transported by pipelines, but you also can make it into a liquid, even though it's very difficult to make into a liquid. You have to chill it down to minus 260 Fahrenheit, and you need a big refrigeration system in order to do that. So this is what a conventional oil and gas production field looks like. I just threw this in here. Generally, what you're looking for is a caprock structure. Usually there's a gas cap on top of the oil, which then sits on top of water. And when people are drilling for oil, they try to drill into the oil level. They usually try to avoid the gas on top of it because they want the oil, not the gas. And then actually when the oil goes up, pretty often it contains natural gas that needs to be separated out before the oil can be safely shipped. So good things and bad things about natural gas. It's generally abundant and cheap in the US. It's easy to burn cleanly, no funny smells or particles, and especially when you're replacing coal plants with natural gas plants, there's less particulates in the air, and in that sense, it is a cleaner fuel. It also, when you burn it, provides less carbon dioxide than burning coal. There's the carbon to hydrogen ratio is 4 to 1, 4 hydrogens, 1 carbon. In most hydrocarbons, it's 2 to 1, and in coal, it's almost all carbon is where the energy is coming from. So there's less CO2 coming from burning natural gas than from burning other fuels. So compared to other fuels, people talk about this as being environmentally friendly and clean energy, and you find the industry talking a lot about the clean energy benefits of natural gas. There's also bad parts. In Pennsylvania, we've paid a lot of attention lately to the fracking of shales in the north and the problems that that causes, environmental and community. And then the other thing is that's bad about natural gas is it's relatively hard to transport. You need to put it, because it's a gas, if you release it into the atmosphere, it's going to escape. And so the only way to deal with natural gas is to always keep it in a closed container, which means either a pipeline or inside a big thermos bottle, which is essentially what a liquid natural gas ship is. So here, I'm living in Spokane right now. I'm a relatively happy natural gas customer, and I can tell you why. The reason why is I moved from Fairbanks, which had no natural gas. And in Fairbanks, I was paying $4.50 a gallon for heating fuel. So my heating bill for heating my house was about $5,000 a year. When I moved to Spokane, this is for August, so I'm only using this for hot water, but if you look very carefully, I used 11.772 therms. How many people here have natural gas at the house they live in? Okay, how many people have you looked at your bill and know what a therm is? Oh, excellent. That's exactly the response I always get. Nobody knows what a therm is, okay? What a therm is 100,000 BTUs, and a BTU is a British thermal unit, which is the amount of energy that it takes to raise 1 pound of water 1 degree Fahrenheit. And if you think about that, that's a very small unit of energy. 100,000 BTUs is about the same amount of energy that's in 3/4 of a gallon of gasoline or heating fuel. So if you look at this, I'm paying, in my bill, I was paying 87 cents for the amount of energy that's about equivalent to a gallon of gasoline on that order. So guess what? It's pretty cheap. Compared to other fuels that are out there, natural gas is cheap. Now here's another trick too, is one of the things that's going to happen the whole way through the talk, and the reason why I handed out the list of terms is because depending on what part of the market you're talking about, people use different units to talk about natural gas. And it's very confusing when you first try to start figuring out what's going on because you read one paper and there's one set of numbers, and you read another paper and the units are completely different. You say, wait a minute, this is a different number than I saw before, because the units are so confusing. So here we're talking about a therm at 87 cents. A decatherm is 10 therms, or 1 million BTUs, an MMBTU. And so 87 cents would correspond to $8.70 for a million BTUs, which is the unit that we're going to be talking about the rest of the talk. Now here's a map of the pipeline structure in the US. This came off of, I think, one of the DOE Energy Information Administration, which is where a lot of this comes from. If you look at this very carefully, you can tell where the natural gas fields are because there's concentrations of pipelines. Those are the gathering pipelines that essentially take the natural gas from the wells, the wellhead, to a gathering point, and then it gets shipped into a pipeline for transportation. And actually, this line going up the East Coast here is the Transco pipeline that was built in the late 40s and early 50s. It was intended to carry natural gas from the Gulf Coast of Mexico up to New York City and the Boston area. And there's also a series of about 4 or 5 pipelines that go up the western side of the Appalachians that also are serving the same markets. I live in Spokane. There's a pipeline here that comes, actually there's some that come down from Canada, and there's one that comes out from Wyoming. Williams runs the pipeline that delivers gas to my house. I am a Williams customer. Let's talk a little bit about the way pricing works on natural gas. If we go back to, let's see if this, let me see if I can go back. Actually, if you look here, there's in this nest of pipelines down in here, there's a spot where a whole bunch of pipelines from different companies come together, and it's called the Henry Hub. And what people do is they often quote the price of natural gas as the spot market price at Henry Hub. And so if you go on the internet and you look up what's today's price of gas, they will give you a number that's quoted at the Henry Hub, which is the spot here. What happens is generally, like, there's also something called a city gate price. What you do is you take the Henry Hub price and you add to that the tariff, the charge for shipping the gas through a pipeline, and you wind up with what they call a city gate price, which is essentially what your utility pays for that gas when it's delivered from the pipeline system, and then you as a customer pay a little bit more than that. So that's the way the pipeline system works. But the Henry Hub price really is the basis of this. And if you look at this, what you see over the past, this is 15, 20 years, you can see that there's been several spikes in the price of gas at the Henry Hub. I think it peaked out at about $13 in 2005 or something like that at one point. But you can see lately it's actually been fairly low, and we'll talk about that a little bit more. Here's a picture of a schematic, essentially, of gas distribution that was from 2011. This is from a company called Range Resources, which is a major natural gas company. What they show here is this was the beginning of the Marcellus shales being developed. And so they show this long oblong because at that point in time, gas was coming both from the Gulf Coast to the Northeast, but the shale gas was beginning to be developed, so they're showing that bubble going all the way up there. Here they're showing the Gulf Coast, the natural gas going to the petrochemical industry. And so that's just essentially a schematic showing you from the previous picture of the natural gas where the gas is actually moving. So what's the value of natural gas? In some places, natural gas has a negative value. And what I mean by that is in an oil field where you want to ship oil and there's natural gas dissolved in the oil, you actually have to get rid of it before you can safely ship the oil. So people there just flare the gas. I remember pictures in National Geographic of the first pictures from space and seeing the oil flares in Saudi Arabia in the 60s. And that's because they were getting rid of the natural gas so they could ship the oil. Close to the gas fields, natural gas has a very low value. Sometimes people try to put electrical generation plants there. In Alaska, they actually put in a fertilizer plant that turns natural gas into ammonia, which is a fertilizer that's used in our fields. The other point, too, is that natural gas has to compete with other low-cost fuels, including coal. And we'll talk about that when we talk about the world markets. And actually, natural gas has its highest value in markets concerned with CO2 emissions, and this includes Europe and Japan. So what's happened to natural gas markets over the past decade or so? The expectations before 2005 was that U.S. natural gas supplies are drying up and that expensive LNG imports are expected to fill the gaps. And actually around the U.S., people were building LNG import terminals. I think Cove Point actually was built in 1977, intended as an LNG import terminal, and has been used occasionally to import liquid natural gas into the U.S. What happened in 2008, though, was the shale gas boom began. And what that meant was there's lots of natural gas very close to East Coast markets. New York City, Philadelphia, Boston, they're all relatively close, much closer than the Gulf Coast. And so what happened is by 2010, LNG imports looked improbable due to new sources. And actually, this is the time at which I was starting to look at gas pipelines in Alaska. People were talking about building a gas pipeline from the North Slope of Alaska to Alberta, where you could link into pipelines that were connected to the Chicago markets. And I first began looking at natural gas, doing the analysis of the cost of building the pipeline and transporting the gas, and came to the conclusion fairly quickly that that gas pipeline was not going to be built as long as the shale gas was viable. So the shale gas essentially has changed the entire market for gas in the United States. The other thing, though, is that Asian markets, which are serviced by liquid natural gas, look pretty strong. So I think I talked about some of this already, but there's a couple of numbers here that I want to talk about. You know, fracking is the way you get the gas out of shale, gas and oil out of shale. Production began about 2008 and rapidly rises through 2014, peaking at about 15 billion cubic feet a day. And once again, that's a really big number, and we'll talk about what that means. But the Northeast urban markets consume about 10 BCF a day. So what you can see is by the time that this peaks out, we're producing more gas in the Marcellus region than we have local markets for in the Northeast. And actually, here's a picture of, there was some gas production in this region before they really started fracking, but the shale gas production really takes off, and we see 10,000 is right here. So they're producing a lot of gas from the shale gas fields here in Pennsylvania. If you look at the liquid, okay, now we're going to talk about liquid natural gas. Up until now, we've been talking about natural gas and pipelines. Now I'm going to start talking about what liquid natural gas is like. Liquid natural gas is liquefied at a gas field and then put on a ship and transported in a huge thermos bottle to a foreign market. And so what you see here is these are ports in the United States. You see Cove Point there, might be familiar to you. But this is the price of gas at those ports. And so in the US, it's about under $4. But over in Asia, you see the numbers are 12 or 13 or $14. And so if you're a business major, you look at that and you say arbitrage, right? There's a huge difference in price between the same product in different markets. And so it looks like there's an opportunity to extract profits from that. But let's talk a little bit about what liquid natural gas is. It's distilled methane essentially, but you need high volume source of cheap natural gas in order to make LNG. You chill the gas to form a liquid by compressing, cooling, and expansion. That's a standard refrigeration cycle. The input gas needs to be relatively pure. If it has carbon dioxide in it or water vapor, you form solids, ice or dry ice, and it basically blocks the process. So it's very important before you put gas into an LNG train that it be clean of those impurities. It requires expensive equipment. They're called LNG trains. Actually, if Cove Point is any judge, they're about $1 billion a piece to put a train in. The lead time on ordering them is about 4 years. So they are big industrial pieces of equipment that you need to buy if you want to make LNG. And in addition to that, producing LNG requires a lot of energy. And what people typically do is they take part of the gas stream coming into the LNG plant, convert it either to electricity or to run compressors directly. But about 15% of the gas that comes into the LNG plant is actually used in the production of the liquid. So you get less energy out than you put in. So if you were going to go around the world and pick a generic site to put an LNG plant on, here's a list of criteria that I found on the web a couple of years ago. What you'd like to have is a field that's at tidewater, and that's so you can back the big ships right in there and load your LNG on the big thermos bottles. You want it near a gas field so you don't have pipeline costs to get the gas from the wellhead to the LNG facility. You want pure gas that doesn't contain any carbon dioxide or hydrogen sulfide or water vapor. You prefer stranded gas, and what stranded gas means is gas that's located in a gas field that does not have a pipeline to a major market. And part of this is due to that energy cost and the capital cost of making LNG. And what you really want is less than $1 per unit natural gas price delivered to the LNG facility. Actually, in the gas world, people talk about 50-cent gas, which means that the price that they pay at the facility is under 50 cents a million BTU to go into it. And if you can do that, you wind up with LNG costs under about $5 a million BTU. And I think probably that's a reasonable estimate for the cost of LNG coming out of Qatar right now. That might actually be high for the gas coming out of Qatar right now. So where in the world is the gas? And I like this slide because all our friends are on it. Here's the US. Okay, we're down here with this little blue thing here. Here's Russia with its big red bar. Oh, here's Iran. Look at that. Boy, I wonder why we have problems with Iran. Here's Qatar, and Qatar, you see, actually has a lot of natural gas to ship. And Turkmenistan, of course, is another satellite country from the former Soviet Union. So you see that there's a lot of gas in the world. Actually, this is only proven reserves. Somebody was asking me about this before. The numbers on this are in trillion cubic feet, TCF. The United States uses about, I'm going to mess it up. Do they say here? World consumption is 114 TCF a year. So I think the US uses about a quarter of that, 23 trillion cubic feet. So we have about a 15-year supply of proven reserves in the US. Okay, there's this whole big discussion on technical reserves and economically recoverable reserves, and I'm not going to go into that. The point here is that there's a lot of gas in the world, and a lot of it is in places we don't really like. And actually, if you look at total annual production, the top 5 countries, you see that the US and Russia are about tie. Canada is kind of interesting. You see Canada kind of rolling off a little bit. We used to get natural gas imported from Canada. I think that's in response to the shale gas boom that's occurring. We see, somebody's sneaking around their sanctions here, aren't they? Oh, I don't know how that's happening. Okay, and there's Qatar, and you can see that Qatar is increasing in production there. And this is an eye chart. I'm sorry about this. This is on Wikipedia. You can go look it up. It basically shows the movement of gas around the world. The blue lines are pipelines. You can see major pipelines coming from Russia into Europe. The pink lines are LNG, and the LNG, you can see, is concentrated a lot around Asia. That's where a lot of the LNG is going to. That's coming from the Middle East and going to Asia, but there's also Australia is becoming a major producer of LNG. There's the West African stuff that's being developed, and actually there's a new one on Papua New Guinea, which is somewhere down in here. And actually, I think I have a chart that shows, well, we'll get to that. You might think that LNG markets are like oil markets, but they're much different. Oil is a fungible product, and what that basically means is if you bring it to the surface anywhere in the world, it has a value that's established by international traders. So basically, if it's $100 a barrel in Saudi Arabia, it's $100 a barrel in West Texas, it's $100 a barrel in China. So that's what you call a fungible product. But oil is a liquid. You can put it in a bucket, you can store it very easily, you can ship it very easily. Natural gas, because it's so hard to transport, actually has a highly variable price. And so this winds up creating various prices for it around the world and arbitrage opportunities. And actually, the spot market in LNG is kind of interesting. If you talk about spot markets, people usually think about that's the price that you pay on a given day. But actually, the spot market is usually to buy an entire shipload for delivery like a month or two down the road. So it takes a while for people to get the ship loaded and delivered. So, but they term it a spot market, even though it's a little bit slower than what we usually think of. And actually, when I first started looking at this several years ago, the markets were very complicated, and even more confusing was the fact that the only information I could find out there were publications that tended to be industry publications promoting certain projects, and they were really kind of hard to follow and understand. The other thing is that a lot of the market is dominated by long-term contracts with terms that are not available to the public. So you have to kind of use generic things to try and figure out what's going on. But when I started putting together the information for this talk, I found a report from June of 2015 by the International Gas Union. There's a web link here, and actually it's on the sheet there too. If you're interested in a relatively current analysis of world LNG markets, I'd recommend that you look that up. It's a much more readable summary than I've ever found before. And let's talk a little bit here about units. This is where the engineering students will kind of groan and everybody else closes their eyes. Pipelines deal in billion cubic feet per day, BCF. The net U.S. consumption is about 77 BCF a day, which is that 28 trillion cubic feet a year. The Europeans tend to use units of million cubic meters a day. There's a factor of 35 between the two. LNG units are in million tons per annum. So when people talk about the output from Cove Point or the amount of LNG that's imported into Japan, they will use a unit of million tons per annum. And right now, the world trade in liquid natural gas is about 250 million tons per annum. And actually, if you look at the local example here, Cove Point takes in 0.85 BCF a day, 850,000 million BTUs. Yeah, that's right, 850,000 million BTUs. And you see why we're all confused. And they produce about 5.25 megatons per annum. And actually, if you look at that, you can actually calculate how much of the gas coming into the plant is being used for energy and the conversion to liquid natural gas there. So Cove Point alone can produce about 2% of the world liquid natural gas consumption based on 2014. If the entire U.S. were using LNG, our consumption would be about 562 million tons per annum, or double the world total that's being shipped around the world right now. And a typical liquid natural gas ship, this is another confusing thing here, they do the volumes of these in cubic meters, but this is cubic meters of liquid. And so it's actually 1 cubic meter, I think, is like 20,000 million BTUs or something. If you have one ship and it has a 22-day turnaround time, you can essentially do 1 million tons per annum on a ship. And right now, there's approximately 300 ships that are shipping liquid natural gas around the world. So that corresponds to that 250 number that we talked before. So it's always fun when you're an engineer, when you deal with these big numbers and you get to the end of it and you add them all up and it's like, oh, that number looks like that number. Maybe I did it right. Maybe not. Okay, and then here is from this report, this is where the liquid natural gas is coming from. This is a percentage of total. And what you see is Qatar is coming online here big time. Indonesia was this one here in the middle. If you guys are history majors, Japan went to Indonesia to find oil during World War II. And we had a lot of fun shooting their ships out before they got back to Japan. It was a 4,000-mile trip. So Japan was continuing to get its energy from Indonesia, but those fields are being depleted. And Australia is stepping up to try and fill in the gap here, and we'll talk about that a little bit. And then here is the West Africa, Nigeria fraction in there. So you can see that there's LNG plants all around the world. Now let's look. The other thing too here is that this is arranged in size going across here. I don't know why they did it that way. And right down here is the US. We are producing less than I think it's less than 1 million tons per annum, and it's actually all coming out of one LNG plant in Kenai, Alaska. So right now, the U.S. is producing almost no LNG for the world market, at least as of 2014. So let's talk a little bit about how LNG is typically priced in Asia. The traditional JKT market price was based on a price of oil, and it's 14.85% of the price of oil, of a barrel of oil, plus $1.25. And I think the reason why this became the benchmark is because the original people that built these LNG plants were actually oil companies. And oil companies are used to dealing in a commodity where they can project the price of it, and all their economic decisions are based on that. So when they cut contracts with the Japanese or the Koreans, they said, we want to base it on oil because that's the thing that we're familiar with. So oil at $100 a barrel, the price winds up being about 16 bucks. If it's $45 a barrel, which is about what it's hovering at right now, it's just under $8 a million BTUs. But right now, Asia is also getting energy from other sources. China is buying cheap coal from Australia at about 42 bucks a ton. And also China right now is experiencing lower economic growth. So the growth in the LNG market is actually slowing down compared to what people expected. The other event that really affected LNG markets was actually Fukushima. What happened with Fukushima is, of course, we know the nuclear power plants by the ocean flooded, and Japan shut down all of its nuclear power plants. They needed a source for electricity. They started purchasing a lot of LNG, especially on the spot market. But right now, Japan is in the process of restarting its reactors. I think in the last month or two, they've started a couple. And each reactor that they restart displaces the energy of 1.25 million tons per annum of natural gas. So you see that if they start 40 reactors, that they could potentially displace up to 50 million tons per annum, which is about 20% of the liquid natural gas. So there's a decline that's coming on in the demand from Japan. And actually here, this is from this IGU report. And what you see is in 2011 is when the spot market starts getting a little intense. And that's a direct response to the demand for LNG from Japan. So here's a graph that compares LNG spot market prices over that period of time. I think the top two lines are based on oil. And then this one here is what they think the long-term LNG contracts are, and then they show the development of a spot market here at the end. And the bottom line here is the Henry Hub prices. So there's a huge difference in price between Henry Hub and Fukushima. Between Henry Hub and Japan. And the other thing that happens here is if you look at this, in 2012, there's a real dip in the price of gas at Henry Hub. And corresponding with that dip in the price of gas at Henry Hub, the US DOE releases a report advocating liquid natural gas exports from the US. So they did their cost analysis based on the price of of natural gas at a trough in pricing. So just kind of interesting that they did. So here's what the fuss is all about, is that if you look at this in March of 2013, now if you think about it, March is the end of the winter, so people have depleted their stores of natural gas that they might have had around. And the price of natural gas in Asia is going for $20 a million BTUs roughly, and over here in the US we're still sitting at $3 or $4. So the question is, okay, it's a gas in a pipeline on the Gulf Coast, but you want to make it liquid, so how much does it cost to do all those conversions? And the rough number that people are using right now is about $5 for conversion from a gas phase to liquid natural gas. That's for the capital of your plant. That's for the energy that it takes to do it. It's $2 for shipping per unit, and that's including tolls on the newly widened Panama Canal. The Panama Canal right now is being widened so that it can take some of these larger natural gas ships, and it takes a couple of weeks off the turnaround time to go from the Gulf Coast to Japan. And so you add to that the price of natural gas at Henry Hub, which is about $4, and you get a number that's $11. And in general, what people talk about is when the spread between Henry Hub and the Asian spot market is more than about $7. It looks like LNG from the Gulf Coast would be cheaper than oil-indexed LNG in Asia. So, and that happens at about, when oil is about $75 a barrel. So in 2013, 2014, what did the world look like? The Henry Hub prices have been averaging about $4 for several years. So it looked like that spread was there. JKT was about $16 for several years. The $12 spread was much larger than the $7 you needed to cover the LNG conversion and shipping costs. So what started happening then is the LNG rush begins. What people wanted to do was get rid of the shale gas glut in the US and look at potential huge profits in shipping this LNG to Asia. So this is from the IEU report again. This is the report that came out in June. And what it shows is LNG expansion plans. And actually, if you look at Qatar, is the Middle East here mostly. Actually, that's Qatar, Yemen, and maybe Egypt and Algeria are in there. And you look at that, and what you see is these are existing LNG facilities here. And the Middle East is sitting on its LNG production right now. The same, well, that's actually not true. Those are the guys that are sitting on it. Asia Pacific, in here, Australia, this is actually Indonesia and Australia, they're existing in here. Australia has made major investments, a couple $100 billion that's being invested in new gas fields to make LNG for Asian markets. And they also plan to do many, many more. But if you look over here at the US, you see this huge blue bar. And the blue bar, it says pre-FID. FID means final investment decision. So these are projects that have been announced and people say they're going to build, but nobody's put any money on the table yet. Okay? So, and if you look at that, that's a huge bar. Well, how huge is that bar over there in North America? So I went there and, okay, if we get up to half of that bar, we're at double the double the world LNG capacity. And if you get up there, we're going to export more gas than the US consumes. So the question is that realistic? And the answer, I think, is that most people in the gas industry think not, and they're expecting to hear people starting to postpone or cancel these LNG projects. But so far, nobody's flinching at the table. There's, I think, only one postponement been announced in the US. But that is way too much capacity for any reasonable assessment of the demand in the world right now. And then here's essentially the same kind of information, but looked at a little bit differently. This is the IEU report. Oh, and we'll talk a little bit about that big number in a minute. But this is, if you look at this, 2014, 2020, so if the bars are the same height, these are the people that are holding on to their bets. They're not expanding right now. And if you look at the Americas over here, the US, if you look at this, we have almost no LNG production right now, and they're showing us going to, I think, 44 million tons per annum is what the IEU thinks the US is actually going to build because they can't believe we're dumb enough to try to build 672 MTAs. So, and then the Middle East is sitting on their bets. The other thing, these little blue dots here are something called a capacity factor. And what a capacity factor is you can build a plant but not run it all the time. So the amount of time, the capacity factor is the amount of time that you could run, the amount of time you do run it divided by the amount of time that you could run it. And if you look at this, right now the US has a very low capacity factor. And I know that that's because the LNG plant in Kenai wasn't operating for about a year. So I don't know what the capacity factor would be if we actually did build these plants. But, and you can see too that there's some other places that have very low capacity factors. Egypt here, their capacity factor is almost zero. So that means they have an LNG plant that's sitting there and it's not operating. So lots of information in that one. So a little bit about the North American plans. The North American plans includes both US and Canadian plans. The US has 269 million tons per annum, which is still more than the world market. mostly on the Gulf Coast. Canada has 350 million tons per annum. That is mostly on the British Columbia coast. And if you think about British Columbia, it's on the Pacific. It's about 4,000 miles away from Japan. And they actually have large shale gas fields that are within a couple hundred miles of the coast. And so there are a lot of people out there, including Exxon, the big oil company, that are looking at British Columbia as a great place to actually put in some liquid natural gas because of its proximity to Asia. Australia projects are underway with huge cost overruns. That's the other thing that wound up happening to Australia, is because people started trying to build these things, there was a crunch back around 2010 in terms of construction workers and materials. So let's talk a little bit now about the Atlantic Sunrise, and I call this the selling of the Atlantic Sunrise. How did Williams present this project to its investors? And we have documentation of this because there are public presentations available on the web of what Williams showed people when they were running their open season. What an open season is in the pipeline world is if you want to build a pipeline, in order to get a permit to build it, you have to prove that there are people that are willing to use its capacity. And so what you do is you open a bidding process to the public and you ask shippers, if I build this pipeline, how much of the volume would you commit to purchase? So basically it's a way of pre-selling the capacity in the pipeline. And in order to do that, they create documents where they show people in the gas markets what they think the pipeline could be used for. So this was presented to investors in 2013 and 2014. And then this information was also presented to FERC. So let's go back to the shale gas production graph that I showed you before. And I put a line in here at 10,000 BCF a day, which is essentially what the local markets can meet. That basically if you're producing 10,000 BCF a day, you're producing enough gas to meet New York and Boston and Philadelphia. But you see what happens right here in early 2013 is the local production in the Marcellus Shale region goes above the local consumption. So what's happening here is we are now creating a local glut of gas in the Marcellus Shale region. And this is when the Williams company goes to the gas companies to pitch their idea for a gas pipeline. And so what does Williams tell the gas producers is going to be driving the demand for gas in the future? There's a huge upsurge in exports, and almost every other demand for natural gas is flat. Okay? So what they're telling people is you got a glut, we got a place to send it. And actually, the other thing that they presented here was a map of the Atlantic Sunrise project, and what they're really showing is the Marcellus gas being used to push gas all the way back to these premium markets. And what are the premium markets they list? They list all of the names of the LNG plants that are being proposed for the Gulf Coast. So as far as I'm concerned, when they sold the Atlantic Sunrise, they sold it as a project intended to meet the demand for exports for LNG. The shippers identified in the open season. Well, first of all, let's talk a little bit about the expectation is when you look at a shipper on a gas pipeline, what you're really looking for is a gas field that's selling gas and a utility that's buying the gas on the other end. They sign a 20-year contract, you know that gas pipeline is going to be full for the entire time. And so for domestic consumption, the open season process is a legitimate way of proving that there's public necessity and benefit in building that pipeline, because people are producing the gas, people in an urban area need the gas, and the public benefits from that process. Let's look at the shippers identified in the open season for the Atlantic Sunrise. What you see is half the capacity is taken on by Cabot Oil and Gas, which is a major driller in the Marcellus gas region. And mostly I'm just going to focus on that half. You know, when I look at the documentation, and actually the first time Bob called me and told me about this pipeline project, I had been looking at Alaska, and Alaska's trying to get gas to these markets too. And I said, I know exactly what these people were doing. They're trying to get their gas to these LNG markets in Asia because they think they can do it. So let's talk a little bit about that 50% in there. So who's buying the gas? And in the FERC, the documents that are given to FERC, when I went through it, I could find only one consumer on that line. Most of them were producers. So the producers are buying capacity in the Atlantic Sunrise project, but it's not clear who the buyers are. However, Cabot Oil and Gas has publicly stated where its gas is going. There's a press release out saying that 350,000 decatherms a day are going to Japan through Cove Point. The other $500,000 are going to WGL Holdings Corporation, and WGL Holdings is providing the other 500,000 decatherms a day to Cove Point. Now, WGL Holdings did put out a press release saying, oh, we're getting the gas from another company, but I think most of the Atlantic Sunrise, at least half that capacity there, is directly for exports through Cove Point. So the other thing too is, let's talk a little bit. I've been throwing some really big numbers around here, and there was a mathematician named Martin Gardner who talked about the problem of illiteracy. And what he meant, we all know what illiteracy is. That's when you look at a word on a page and you don't know what it means. Well, people, when they look at numbers, they can look at a number and not know what it means. You know, it's just a big number. So what's the difference between a million, a billion, a trillion, or for God's sakes, a quadrillion? Those are all big numbers. So we need to pull these big numbers down to something that we can understand, and that's what I'm going to try to do with you. So how much is 850,000 decatherms a day? If you go to the EIA website, which is a great place to hang out, you find out that the U.S. consumption is just about 100 quadrillion BTUs per year. That's 98 with 15 zeros behind it. That's a really big number. So let's divide that by the population of the U.S., which is 318 million, and divide by the number of days in a year, and we get a U.S. average energy consumption per resident of 845,873 BTUs a day. And what that really comes down to is about the equivalent of 7 gallons of gasoline. That's what we all use to keep our society going. That's a lot of energy. And what's the population of the people along the Atlantic Sunrise population? If you add up I went and got off of the internet, God bless the internet, the population of the 5 counties, you add it up, you find out there's just under 1 million people that live along the pipeline route. So, and you do the math here, you multiply the number of people by that 873,000 BTUs a day, and you find out that along the pipeline, the entire population of those 5 counties uses 823,000 decatherms a day. So that's a smaller number than the 850,000 decatherms a day that's being exported from Cove Point. So what that means is that every day the pipeline is operating, it is shipping out of the country enough energy for every citizen in those 5 counties. Every day. And Atlantic Sunrise is twice that size. On top of it, you can go to the DOE website and find a list of other pipeline projects that are proposed for the Northeast. And you find out that there's a total of 26 pipeline projects in various stages for this gas out of the Leedy hub. It's a total of 34 billion cubic feet a day of pipeline capacity that's being produced. This is twice the total current production out of the Marcellus Shale region. And a lot of the gas is already moving to the domestic markets. So why do we need 34 BCF a day of new pipeline capacity out of a place like that? So why the push to export U.S. gas? Well, Japan, Korea, and Taiwan are looking for price reductions in their gas. They're looking for somebody to give them a better price, is what it really comes down to. And they are investing in many of these U.S. LNG projects. But it also looks like people are investing in what they call portfolio purchasing, which is where instead of purchasing gas to be taken from one point to another point, they're purchasing gas at the dock to be delivered anywhere in the world. So that means that the intention is to play the stock market. But when I did a back of the envelope calculation, having access to the Henry Hub LNG in 2013 could have saved Japan about $15 billion. So that's a big number. Boy, I don't know what was there. So anyway, let's talk about where LNG prices are right now. Okay, this is the map of the world with LNG prices, and what you see is the LNG prices in the US are still relatively depressed, but in Asia, they're also depressed. There's less than a $7 spread between the price of natural gas in the US and the price of natural gas in Asia. So basically what has happened is the price of natural gas, liquid natural gas, has collapsed along with the oil markets. And it no longer looks like these LNG projects are feasible. So a few things to ponder here. The total flow through the Atlantic Sunrise is twice the entire energy use of all the people in the 5 counties the pipeline will pass through. At some point, the gas will run out. It might be 100 years from now, it might be a long time, but sometime the shale gas is going to be gone, and we're going to have to get our energy from somewhere else. Every day the pipeline runs means 2 days worth of energy needs to come from somewhere else in the world. And what's really brilliant about this, if you're a gas company, is you get to profit both ways. You profit selling the gas the first time, and you profit when you bring the energy back. So final comments, I'm a natural gas customer. I like my gas. I think it's cleaner than coal. There's some legitimate climate change arguments for switching energy supplies. I understand the U.S. has a balance of trade problem right now. We have to pay for the cheap crap we buy at Walmart somehow. Recent LNG price differences between 2011 and 2014, I think encourage people to look at Asia as a very attractive market where we could profit selling LNG. But there's lots of gas around the world. Much of it's located far from markets. A lot of it's located in countries we don't like. But I think current LNG prices do not justify LNG exports from the U.S. My preference is to develop stranded gas fields to provide LNG for places like Asia and leave domestic gas fields in place for our markets in the future. It appears that there's a massive overcommitment to the building of LNG facilities and pipeline. And there's a couple other things too that kind of rankle a little bit. Right now in Pennsylvania, there's no taxes on these major pipeline projects. In some places, if you can tax a pipeline, you can lower the property taxes for people that live next to it. People seem a little bit more amenable to it. We don't even get that. And then unlike electricity, when we think about when electric transmission lines were built as part of the rural electrification program, there was a commitment to providing electricity to every farmer out there. So if a farmer had an electric transmission line going through his field, he understood that he was going to get electricity for his house also. What's happening right now is I grew up in Mardick Township, there's no natural gas there. So people are being asked to have a major pipeline go through so other people in the world can have cheap energy that they don't benefit from. And I had a photographer who once noted that it's ironies like this that do not sweeten our lives. So, and then the other thing too, there's a question of fairness. The benefits from exporting LNG accrue to the owners of the gas fields, pipelines, and LNG facilities. And one apparent aim of the gas industry is to alleviate the gas glut and raise prices for all U.S. consumers. And when the price of natural gas goes up by $1 a unit, I did the math on it, over 50 years, that results in $1 trillion worth of wealth going from consumers into the hands of the corporations that own this. And even more than that, you know, for LNG exports right now, it doesn't look like it's economically viable. It looks like the profits, if there are any, are going to go into the hands of these corporations. And I question the legitimacy of granting the right of eminent domain to people who are building a pipeline for export. That was the end of my talk last night. I have one more slide here, though. people gave me a hard time about going too easy on the gas industry and not talking about climate change. So I have thought a lot about climate change. So I'm going to give you one slide of what I think about climate change. As I see it, the problem that we have with climate change right now in fossil energy is our fossil energy is too cheap and we use too much of it, and we've built our entire infrastructure based on cheap energy. And I have a modest proposal in the Jonathan Swift sense of the word. I think what we need to do is put a tax on carbon, and I'm suggesting a value of $200 a ton. And the reason why I say $200 a ton is because in the research that I've done, that is the level of taxation that it will take to really drive low carbon energy sources forward. And my proposal is to do something like they do in Alaska. I was in Alaska, we got a permanent fund dividend check every year. And the way that it worked is the state was collecting taxes from the oil industry and then distributed them to every citizen. Every citizen got exactly the same check. So basically what you would do is you would collect the $200 a ton tax on the energy source when it leaves the ground. It goes the whole way through the economy. You as the consumer pay a lot more for it. The money goes into an escrow account at the government, and I know this is where it gets really tricky because nobody trusts the government. But then at the end of the year, what the government does is hands out a check to every citizen for exactly the same amount. And the check that gets handed out is based on what the government recognizes as a low carbon or an appropriate carbon target. So if you use less than the government's target, if you have a low carbon lifestyle, the check that you get is greater than the amount that you paid in taxes through the entire year. If you have a high carbon lifestyle, you've paid those taxes and the check that you get doesn't compensate you for it. And I think this is the only mechanism that I know of whereby we can encourage people to change their lifestyle, to drive smaller cars, to live in smaller houses, to live in more compact communities. All these wonderful things that everybody wants to promote, and basically we don't know how to do it. This is the only mechanism that I know. And I do think it's a modest proposal, and I do expect to be tarred and feathered for suggesting it, but that's the best idea I have.